One of the questions we get from clients is how we actually distill a lot of that broader market information, a lot of the macro information that we get. How do we distill that in terms of our thinking and ultimately into portfolio positioning? And we take what's commonly known as a top-down, bottom-up approach. When we think about the broader macro environment, we're trying to identify some of the key drivers. It may be related to political risk, it may be related to interest rate risk, it may be related just in terms of broad valuations that we see across particular markets. We identify what we see to be the key drivers. How will that then ultimately feed through in terms of our asset allocation positioning? When we think about asset allocation, how do we position to equities versus bonds versus property versus cash? Once we get that framework right as best we can, we then think, well, how do we then build up those individual positions into those particular asset classes? And that's the work that we would say is defined by bottom up. It's identifying particular securities, external investment managers, investment opportunities that can feed into and, in our view, take advantage of that external macro environment. So a really good example of how we're seeing the macro flow into our portfolio decision making, if we just look at emerging markets and we look at the US-China trade dispute, and we also look at the decisions in terms of interest rate moves by the US Fed. So the trade dispute, how does that flow through? Well, that's ultimately resulted in slower economic growth out of China. Now, you'd sort of then extrapolate that into thinking about, well, what does slower growth out of China mean? Well, Australia being a resource-rich country, China's our biggest market for iron ore, coal, gas. That has implications in terms of the potential earnings outlook for companies such as BHP, Rio, Fortescue, etc. So when we look at these sorts of trade issues and we look at some of these macro issues, we then think about that. What does that mean for the individual securities? What does it ultimately mean for the performance of those financial markets? So in a broad context, do we want to be as overweight BHP as we were previously? Will it have impact on BHP earnings? What will it mean for Fortescue, Woodside and the like? And when we think about emerging markets, is the risk too great, knowing that the slowdown has implications for the performance of those markets more generally? So when we position that, our core view is that's something that we need to take into consideration. How do we manage those risks? Equally, when we see it with the rising US dollar and higher bond rates, what does that mean for financial markets generally? And you can see that the drawdown of capital may see the US dollar rise from other countries. So when we're thinking about investing globally, do we want to have a lower exposure to the US dollar and be more underweight from that perspective? So that means the return profile that we're getting from our Australian dollar investments may be greater. So when we're thinking about that in a portfolio context, it's owning companies like Treasury Wine Estates, James Hardie, Brambles, CSL, where we can get an advantage not only in terms of the quality of that business, but when those returns are translated back into Australian dollars, it creates a higher uplift in terms of the overall return.